We actually think that the Fed will be delivering a hawkish cut today, simply because the market is pricing in almost 70 basis points of rate cuts, excuse me, this year, about 150 basis points for the cycle. And we think the Fed at most is going to send a signal that they'll be cutting twice this year and only twice next year. So in relation to where the market is priced, we do think that that's going to come across as somewhat hawkish. Now, we don't think that Powell is going to tell the market that it's wrong. But we do think that he's going to provide very limited guidance. He's not going to guide on October. The market's pricing in about 20 basis points of a rate cut at that meeting. And we just think that the market, if they're looking for any justification that this is a Fed that's going to be cutting quickly, won't really get that through the mix of communications today. Now, the market may look through that. It may know that, look, the Fed is not going to tell us that they're cutting in October, and it may be more focused on the dissents, the size of those dissents, and then what the market thinks that means for how the dissenting officials will vote in the future. The Miran dissent is key for the market. He's new. We don't know much about him and how he thinks about monetary policy today. So if it's a 75 basis point dissent or a 100 basis point dissent, the market will be taking some cue from that, we expect.
Do you think he would go as far as dissenting for a 100 basis point reduction at this meeting?
It is a low probability, but I wouldn't rule it out.
Jerry, this goes to the question of what people do with that in allocation. Does that mean just keep going into risk assets and sell long bonds? Or does this mean everything could be bid up because suddenly we're looking at unconventional policies that will lift all asset prices in the United States?
It's a great question, Lisa, because I think the moment of truth is coming for a lot of investors. Think about all the people who've been content, even thrilled, to have spare cash sitting in higher yielding accounts, money market accounts, earning 4%, 4.5%. As Mark and our economists and everyone thinks ahead to the future and we forecast a terminal rate next year of 3.25%, suddenly those higher yielding cash accounts start to look a lot less attractive, especially if inflation remains sticky. You've got a big decision to make at that point. And to your point at the top, Lisa, actually, the tension now isn't just between the soft data and the hard data, which we've been writing about all year, the surveys that are negative, and the economic data, which is holding up pretty well. It's now almost a fight between the hard data and the hard data on the labor side and retail sales being strong. So investors have to decide. If the Fed's behind the curve, if the economy is actually getting weaker, then maybe that cash isn't looking attractive, but longer-term bonds might be good for a trade. If the economy holds up, if the airline executives and the bank executives and the retail sales data all confirm economy that's really strong, there's lots of places to go in equities that are going to be more attractive than cash. It's hard to overstate. This isn't cash on the sidelines. This is cash on the sidelines in the bleachers up to the press box, amount of cash with almost $20 trillion in cash and cash equivalents today.